Hey, good morning, everybody, and welcome. It is Saturday morning, Multifamily Unplugged. Glad that you are here today. And if you are new to the show, please make sure that you buckle up for this ride because this morning I think you're going to be intrigued by our guest. As I talk about every week as we get started, have you looked at your intentions here this morning? I named my company My Core Intentions because I wanted to be intentional about what we brought to the marketplace, the content that we brought to the marketplace. And I want to encourage you the same to be intentional about your goals and what you're trying to accomplish. So go grab your coffee, sit back. You're going to enjoy this morning's conversation. Remember, this show is brought to you by My Core Intentions. They're the sponsor. If you are looking for any educational processes, learning to underwrite a little bit more, property management, maybe just learning the due diligence process a little bit deeper, give me a call. Be more than happy to see if we can't spend some time together, even if it's just some straight networking. I love to connect. You know that. You can reach out to me at mike@mycoreintentions.com. I want to thank you for being here. You might want to go wake somebody up too. I am joined this morning by Brandon Jenkins. He's calling in from the Washington, D.C. area. Brandon's a multifamily investor, invests a lot in the Houston, Dallas markets. I'm going to let Brandon tell his story, so let's bring him in. Brandon, good morning.
Hey, good morning, Mike. Thanks for having me here.
Yeah, you bet. I enjoyed getting to know you. I was on your show just a week or so ago, and really had a good time, and it was good to connect. So I thought that this would be a great place to have you on here this morning. So thanks for participating with me.
Absolutely, it's a pleasure.
Hey, one question I always ask my guests when we first get started is, in one word, what best describes you personally and professionally?
That's a great question. So I would say resourceful. But by profession, I'm a petroleum engineer. So I worked for a long time as what's called a drilling engineer and worked as a reservoir engineer. And so in both of those roles, it really involves risk, operational risk, cost, and material risk, personnel risk. So all these things that you have to consider in getting the job done. Well, I've leveraged some of those professional skills over now to the syndication space, where both personally and professionally, I need to be resourceful in order to connect, people to what they need, connect investors to the types of opportunities that they're looking for, connect syndicators to the right potential partners. So all of these things that I've had to sort of dig into my more resourceful side in order to find what's needed in order to get the job done, but also to be able to properly sort of connect the dots for some people and for myself.
Boy, you've opened the door up to the whole conversation here this morning. Let me tell you that already. But before I start jumping in and asking some questions, let me ask you: would you tell the listeners a little background about yourself?
Absolutely. So born and raised in the DC area. And, as I mentioned, I started off as a petroleum engineer, but my degree was in chemical engineering. And so very technical by nature. And so I really, kind of appreciate the analysis. The reason I started off in real estate, however, was initially as an employment, to mitigate employment risk or the risk of unemployment. If you're familiar with the oil and gas space, then you know that it's very much up and down, very volatile. So when things are good, then it's really good. But when things are bad, then, it gets really bad and they start to lay people off and downsize, these sorts of things. Okay. So my initial reason for stepping into the real estate investing space was to offset that. Right. And, but it quickly turned into something that I'm passionate about and that I really enjoy doing. And so I got to around 12 units on the single family side in a market that's just outside of Houston. And I wanted to scale. So I started to look for multifamily deals and started to put in offers and these kinds of things. Nothing panned out, but I still had that hunger, that longing to scale. And so one of my coworkers, who's a good friend of mine, he and I had a conversation, and he was aware of syndication deals. And so that's how I got into the space. One of his neighbors actually was a syndicator and a capital raiser. And so he and I had a conversation. We started to go to meetups, and off it went. And so from 2019 to the present, I've been investing in deals both as an LP and then now as a co-GP. And I just love this space. You know, I love the abundance mindset that people have in this space, like yourself. I love the willingness to be open and to share. And you know, I can always kind of talk forever about my journey. You know, I've had some ups and downs. And actually, in 2019, I was laid off, which is interesting because that was also the year that I invested in my first deal as a limited partner. But I sort of turned that around because I had already sort of mapped out a potential path for myself, and I pursued that path as opposed to getting stuck. So that's kind of my journey and maybe who I am in a nutshell. Okay. And I'm happy to be here again. So
yeah, thanks. I appreciate it. So you kind of raise an interesting question here for me. When I first got started in the real estate space and doing investing and being in the single family fix and flip business, I did everything close to home, right? I'm in the Chicago market, so I did everything right, within a 30-minute drive of where I could get to quickly. But I'm hearing you say that you did your single family investing in Houston while you lived in DC. Why single family so far out of your area?
Well, so the first thing I'll clarify, at the time I lived in Houston. So when I was a petroleum engineer, I lived in Houston, but the market where I invested was an hour and a half to 2 hours, depending on traffic, outside of Houston. So it still was sort of a not long distance, but there was a distance. But I'll tell you that due to the demands of my job, it might as well have been a long distance type of play. Because I really didn't have a ton of time to devote to going out to the property and check on things. And so what I opted to do instead was to focus on systems and to focus on sort of the who, not how, so to speak. Who can I put in the right places to make my job easier as an owner operator of these assets. And what I did was to go to the local market there and meet with agents, meet with property managers, meet with other investors, and to start to begin to establish a network of people who I knew over time that I knew could reliably get the job done. And so, what I did at that point was just set up a system where I basically needed to pick up the phone and say, hey, how can we do a walkthrough of the property on FaceTime or whatever it is. And I would sort of get my acquisition piece down. I had systems for that. I had systems for how the property manager would go in and get the unit turned over as needed. So I focused more on that, and I wanted to work on my business instead of in my business. I really took that approach at the outset based on some research that I'd done. So that's kind of how I went about investing with some distance away from where I lived at the time.
Yeah, interesting. So the other thing that you talked about when you were giving your bio a little bit, and the word that stuck out to me was risk. I think that risk management is a big thing, especially in today's market. How do you equate, risk management in the multifamily space versus how you had to look at it in your day job, prior?
That's a great question. So one of the biggest risks in the oil and gas business. So from a development standpoint, when you've identified that there's a potential reservoir, which is basically where kind of the hydrocarbons are. They're deep beneath the surface, so you can't see them, right? Okay. So there's several risks. One is it there in the first place, and how much is there? So there's a risk in terms of like a quantifiable risk. How much is there? What's the potential upside? What's the mid case, best case, and worst case? So that's one. And if I make an analogy between that and sort of the syndication space, you could look at that as your upside potential, or your value add potential. It's I go to a deal and I understand the market as it is today. I understand this particular asset and where it is today. but I'm going to have to make some assumptions on where I can take this deal. And I'm going to have to make some assumptions on what type of whether or not the deal can absorb operational risks and market risks. And then I'll have to move forward, and not get stuck at the analysis phase, but to say, well, I'm going to make these assumptions. They're reasonable. They're based on the market. They're based on what other operators might have seen. They're based on what my property manager has told me we can achieve. And I'm going to move forward. So that's one comparison there. I think the other one is very much sort of the tangible risk. As a drilling engineer, we drill wells that might be 10,000 foot deep and then 7,500 foot in horizontal. And so you have all kinds of material risk to the equipment where again, you can't see it because it's down in the earth. And so you could have damage to your equipment that you won't know about until later. Okay. Similarly, on the apartment side, structurally, you might not know what you're getting into. And so the best thing to do to mitigate that risk is in due diligence to, get very in depth in the systems and the structures that you're looking at to then mitigate the potential risk to the asset.
Yeah. Interesting. So today, the environment that we're in is changing a little bit, right? I think multifamily is the whole investment environment is changing right now because of interest rates and inflation and other things that are going on. What would you say, looking forward right now, is the biggest risk that you should watch out for going into a multifamily deal?
One of the things that I would say is a huge risk today is getting a feel for whether you'll get the return that you're looking for out of your Capex dollars. It's like, you don't want to go into a deal where 2 years ago, you'd spend a lot in Capex because you felt reasonably comfortable that we're going to get a good, strong return out of this, these projects that we're putting into this, out of these upgrades, out of these amenities. And I think that nowadays that's a huge risk, which it just involves some sort of going through it with a fine tooth comb to get a better understanding of, okay, will we really get the ROI that we believe we'll get from upgrading these interiors in this way, or adding this amenity, to the exterior or to the property? Will we really see the return, from doing these projects? And so I believe that's a huge risk because it requires some adjustment. It requires some understanding of what we can actually achieve in today's market.
So are you saying maybe not do as much Capex as you might have done 6 months or a year ago? Are you saying back off on that? Maybe, don't do the whole lighting package, or don't do all the floor coverings, or whatever that capital improvement stuff might be?
I would say at the very least, maybe test it a bit. So a couple years ago, the approach was kind of very aggressive, right? To where it's like we're going to upgrade more units per month than what it might make sense to do now, because I feel that it requires a more gradual kind of, okay, let's test it out, let's upgrade these units, and let's see what we can get, and then let's see how sustainable that is before we actually commit more dollars. But I would say, in short, yes, I would dial back on some of the capital projects unless it's in, say, like a deal where it warrants it. If it's a Class A type of property, naturally, yes, you're going to have to do these certain type of level of amenities and things like that, and interior upgrades. But otherwise, I would dial back a bit on Capex projects unless I'm sure that I can get the ROI from it.
What's really interesting right now is people are saying values are going to change, but rents aren't going to change. That rents are going to stay strong, but value, are going to back off, which means cap rates are going to obviously go up, right? Because value is going to go back down. So, but it's such a space that's driven by NOI and by the dollars that are brought in on the cash. I'm trying to have I don't want to say I have a hard time getting my arms around that thought process, but I just recently thought that on a deal we bought that we could raise rents about $250 a door, and we're at 400 a unit that we've raised rents on
Wow.
2 bedrooms, and we're in Tampa, Florida on a deal. So it's interesting to me because we just bumped, we bought, the last rent bump we did post renovation was like $12.95. Now we just got another $55 on another one. So they're still going up, and the quality of tenant is going up, which has been very interesting. What so from a standpoint of thinking the whole deal through, why do you think that is? Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets, just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
Well, the two things I would say is one, real estate is still very much hyper local, even in the multifamily game. I think that a lot of us fall into the not trap, but we make the mistake of saying of applying the national market cycle, for our local kind of cycle, right? Every area, every submarket is in a certain phase in the cycle, and I understand that, yes, nationally there might be overall a cycle where the real estate market is sort of trending toward, but that doesn't mean that every market is going to behave the same. So you're the market where you are, because you said in Tampa, I think, and so that's a really hot market where you're just not going to have the same problems that someone might in another market. The other thing I would say is for me, it depends on what class of property I'm looking at, and so I've shifted just a little bit, at least on the limited partner side, so on the passive side. I've shifted to trying to offer myself just a little bit of protection against the potential cap rate expansion by targeting sort of at least class, B plus, A minus, or solid A even deals. Because if there is a change in cap rates and valuations, those classes of properties are unlikely to see a shift in the way that some of the a class C might, as an example. So those are the two things that I would say maybe kind of should be considered.
Yeah, that's really, I think that's good thinking, and I think that we all have to start to shape our thinking a little bit differently than we would have 6 months ago. It's funny is I get a couple phone calls yesterday from brokers who are reaching out to you now, where, 6 months, 12 months ago, they were hard to get a hold of. They weren't returning phone calls. They don't want to talk to you. And I asked this guy yesterday, I said, why all of a sudden are you calling me? And, well, our buyer pool is shrunk. And, so I think there's a lot of shifts going on right now that a lot of us aren't even aware of or don't even see. So it's going to be interesting over the next, year for sure, much less, the next 30 months. So I think we're into this thing for a while, but the fundamentals in multifamily are still strong. People say, well, should I wait or not invest? The fundamentals are still strong in multifamily. You should invest. Would you agree with that or disagree with that?
I would strongly agree. I can tell you that I'm definitely all in. And I believe that we should invest. So the dynamics, it's another example of where some people are sort of mixing economic drivers, I'll say, to make a judgment on the multifamily space. So in the single family space, the downward pressure on values there, I find that as soon as the headlines kind of started to get rolled out about that, then people shifted their thoughts on the apartment side, despite the fundamentals being there, despite the fact that actually with the shift on the single family side is actually going to cause support for the multifamily case. And so I think that we need to be careful of confusing the two. And that's what I've seen is a lot of folks are, saying, well, they're questioning it, should I buy? But if the fundamentals are strong, then that's one of the benefits of the multifamily real estate space is that you can actually, make your decision based on the fundamentals, right? Unlike stocks, where a headline can come out tomorrow and then the stock plummets by 20%. The real estate market is just not like that. And so the fundamentals tend to support your decision. The demand is strong. Rents are continuing to increase. Now, I would still underwrite conservatively. So if we're seeing a 10% increase in rents, well, I would do a 4 or 5% annual escalation. But outside of that, I would still base my decision on the fundamentals and what I'm seeing in the market. So yes, I believe strongly that I'm buying, and I certainly would advise anyone else to stay in the game.
Yeah. I want to jump back to markets for a minute and ask your opinion about markets. We have when we look at markets, you have a primary market like maybe a Chicago or an LA, Dallas, and then you have your secondary markets, but then tertiary markets, right? Those outlying areas. Any opinion on a tertiary market?
Yeah. So I believe that, so I like tertiary markets. I can tell you that, a lot of the questions that I've been, that I've been asked of investors is, well, how can I still get strong cash flow in an uncertain environment? I think that in tertiary markets, they tend to hold just a little bit better than some of the primary markets or the gateway markets that see a lot of volatility and a lot of ups and downs sometimes. But it depends. I read an article the other day that said that there might be in inflationary periods there tends to be a shift back to gateway markets.
Yeah.
Your Chicago's, your DC's, your Miami's, and so it is. I know that what I'm saying is conflicting, but that's my stance is I'm not afraid of tertiary markets because I like to have a bit of both. So I do want to be in a market where that the values will be preserved, and that's what we're really talking about. Gateway markets tend to have a decent preservation of value, even though with all the volatility, over time they tend to preserve value fairly well. Tertiary markets tend to, they don't have kind of the same upswing, downswing. They'll hold from a cash flow standpoint, but the valuations might not be that strong, right? So that's my take on it. I know it's a little bit of both, but it's kind of the best answer I could give.
Yeah. I've always thought that the C-class properties and the tertiary markets cash flow a lot better than appreciate, right? And, what I always like to try and do for people is create short-term cash flow and long-term wealth. But, when you start getting into tertiary markets or lower class properties, you have one without the other, really. Which can be okay if you're in the game for cash flow alone. A little bit of appreciation is fine, but a lot of times people say, hey, look, if I can get a 10 or 12% cash return, I'm happy with that. Even if my back end is only 3, 4, 5%. So I think each property, each market delivers its own benefits, right? Where we can all, take advantage of those benefits or not. So,
yeah, it's that almost like that seesaw kind of effect, right? You're either getting your cash flow and your upside from operations, or you're getting kind of the upside from the sale. And you'd be hard pressed to find a market where you just have both of those in play. So there tends to be a balance. And you're right. Tertiary markets tend to favor cash flow, less of an upside or less return from the sale when compared to a gateway city where the cash flow might be low throughout the holding period, but then on the sale that you tend to see more upside. So
Yeah.
yeah.
Hey, let's talk about raising capital. What any good thoughts on raising capital? What's your best process right now? How are you going about doing it?
So one thing that I've found works for me, and I can tell you that I, I'm not good at switching on sort of my capital raise or taking off one hat, putting on my capital raiser hat. What I have found that works for me is making sure that people know what I'm doing. So on LinkedIn, making sure that I post about what I'm doing, making sure that I make people very much aware of what my approach is, what my risk profile is at a very high level, um, so that I'm always sort of grooming my network to say, well, I'll reach out, and if Brandon has something, I already have an idea of what the deal might look like. And it's raising capital is not an easy thing. It's a skill. Some people are good at once they have everything lined up, then they put on their capital raiser hat and they go off and they focus on that. I'm not that good at doing that. So for me, I want to more or less always be raising capital, I guess you could say. So I always want to have my network aware of what I'm doing, what my strategy is, and also want to know whether I'm a good fit for them. But I'd like for them to know that, over the long term, as opposed to me saying, switching it on and saying, am I a good fit, and finding out sort of abruptly. So that's what I do. I put the word out there, make sure I have conversations with my network, but also make sure that I'm always informing them of what I'm doing.
Yeah, interesting. What's people's perception? And I don't know if you've had any recent conversations. What's people's perception today to inflation versus, and I think it's three things, right? We got inflation going on. People want, and people are thinking then that they want to hold on to their cash a little bit more, when really they should be investing in cash flowing products to offset that inflation. What are you finding people are saying about that?
To be honest, I can say that for me, most of the folks who I'm closest to, they actually see inflation for what it is, and they would agree with the latter point that you made, which is, because inflation is high, they need to find places to put their capital so that they can grow and so that they can offset the negative effects of inflation.
Yeah.
So that's kind of the stronger opinion that I've seen. Which yeah, for me, it's definitely the way to go, is to look for investments to where you can outpace inflation.
Yeah, interesting. I had a conversation with the one. This is why this comes up. I had a conversation with a woman last week, and she said, "Oh, I have $100,000 sitting in a savings account, making just under 1%." And I said, "So you're making about 1%?" I said, "Do you realize you're losing 8% a year?" And she said, "What do you mean?" I said, "Well, inflation's at 9. If you're only making 1, the difference between 1 and 9 is 8. You're losing 8%."
Yeah.
And she was, she couldn't get her arms around that. But I know this woman, and I know she went home and did some research and is trying to figure that out, because where we're at, and they're saying this inflationary period could almost reach 15%. So if we're in mid-teens, how are you going to offset that? You got the cost of gas that's so high, and bread and milk and other goods that you've got to figure out for yourself where the best place to put money is. And I find a lot of people don't know about real estate, don't know that they can invest in this kind of real estate. Everybody thinks that, oh, all I can do is invest in single family or my fix and flip, or I have to do all the work. People don't understand about passive investing. So I think good education processes for people help the money raiser, the creative money raiser, a lot. So
Absolutely. I'll tell you, Mike, so being here in the DC area, you have really high household median incomes. The level of education as far as traditional investments is solid. but the level of awareness of what you and I do and to invest in apartment deals and syndication opportunities is just not there. And I saw that as an opportunity to say, okay, well, how can I fill that gap and help share, this with other folks in the area? So I started a meetup here. But you're absolutely correct. Uh, a lot of people don't know about it, and it's and what I find interesting is most people are comfortable, at least they believe they are comfortable with investing in the stock market and mutual funds and these things. But when you ask them, okay, can you pick up the phone and call the fund manager? Can you do that right now? And their response is inevitably going to be, well, no, I don't know who that is. I don't
Yeah.
know anything about I don't know anything about their training. I don't know anything about their performance. I don't know how they evaluate the basket of stocks or whatever it is that this mutual fund is composed of. I don't know what their turnover, is. So all these things that people that have been made to be sort of quote unquote comfortable with, but they really don't understand what they are. Um, and so that I believe is to our benefit because the simplistic nature of apartment syndication deals is what makes the education process a bit easier because we can say, hey, let's drive over to the asset or let's fly out or whatever it is. Let's go see the asset. Let's go put our hands on it. The balance sheet is also something that's very straightforward, or the P&L statement anyway is very straightforward, and it's relatable. So yeah, I feel like the education gap is there and it needs to be filled. But the good thing is it is fairly it's easier to fill than some of the more complicated investment vehicles out there.
Yeah, it's well spoken. Hey, so you just closed your first deal, right?
Yep.
You
Yep.
want to just give us a little insight around that?
Sure. It's a 48 unit deal that's just north of the Woodlands. So it's north of Houston proper. The Woodlands is north of Houston, and then this deal is kind of north of that near Conroe. So a really, really nice market. It's a new construction deal, and it's in a growing county. Great schools, all the right pieces there. And so this is actually a testament to networking. The individual who reached out to me and said, "Hey, look, we've got this opportunity and wanted to have a chat with you about potential co-sponsor role." And so he and I had conversations before we met in person. And so we already had the relationship kind of built. And, I was able to meet his team and introduce him to the folks that I partnered with. And so we were able to make something happen. So we helped raise just a little bit of capital for them. We came in sort of, I would say, 3/4 of the way into the deal. But we were able to make it happen and get them over the finish line. And so I would just say that for anyone who is sort of looking to be on that side, establishing a network is key. It really is it's more powerful than you might think. I know we all say that your network or your net worth is your network or vice versa. But
Yeah.
that is really a true statement though.
Yeah, it certainly is. I've really bought into that over the years. I think it is a true statement. Hey, this has been great this morning. Thank you. I love the whole risk management thing. You really speak to that well, and I hope people go back and listen to this again for that piece of the education around that, because people need to watch out. But as we wind down, I always like to ask 3 bonus questions. So buckle up. What's your favorite tourist attraction?
Oh, that's a good one. So I actually have one that I found out about not too long ago, but it's just outside the DMV area, or what's in Virginia. But it's called Great Falls,
Oh,
and it's so the reason I like it is because it's just outside of DC proper. It's in boy, I forgot. It's near McLean. I forgot the actual town, but it's in It's called Great Falls, and it's to me, it's naturally just really beautiful. It's this rushing, rapid falls that you would just not expect to be this close to DC. So most people think of monuments and they think, right, and politics and everything else. But they don't think of the natural beauty that's just in the area. So for me, that's one of my favorites because it's a hidden gem if you're not from the area. But yeah, I would say Great Falls.
yeah, nice. How about favorite restaurant?
Oh, So you know what, I like Eddie V's. I like
Oh,
Eddie V's because I like steak and I like seafood.
yeah.
And I like old fashions, and they have a really good hickory smoked old fashioned that they do there. Their scallops are good. Their sea bass is good. Their ribeye is outstanding. So yeah, I would say Eddie V's.
Well, I haven't been to an Eddie V's in a long time. We don't have them in Chicago, so
Oh man, they're good. Well, you have Capitol Grill out there, I think, right?
yeah, we have Capital Grill, right?
Yeah,
Same owners, right? Yeah.
I believe so. I believe so.
Best book you've ever read?
You know what? The best book I've ever read. Um, hmm, Gosh, there's so many of them. I was gonna say Rich Dad Poor Dad, which is a bit cliche. So I'll say I think the two, if I might. The One Thing. These are both Gary Keller books.
Oh,
The One Thing, and then Millionaire Real Estate Investor.
yeah.
And now the reason I say Millionaire Real Estate Investor is because he does a good job of making the connection with you on an emotional level before he goes into kind of the how and the mechanics of it. And that was important for me because at the time I had no experience whatsoever as far as real estate investing goes. And when I read the book, it really pulled me in and drew my interest into the why. And so I would say that book just for me is instrumental. The One Thing is always good as well because that book tells you to focus on, you know, doing the one task that by doing it will make every other task easier. So I like that concept.
Yeah. Love Gary Keller. Worked for Keller Williams for years, and one of the smartest guys I've ever met. That's for sure. So, Brandon, thanks for being here today. How do people get a hold of you if they want to connect with you?
Sure. Thanks, Mike. It's been a pleasure. So you can either send me an email at brandon.jenkins, BRANDON.Jenkins, JENKINS, at birchprosper.com. So that's birch, like the tree, BIRCH, prosper, PROSPER.com. I'm also on LinkedIn. I also have a podcast called the Capital Stack Podcast. And yeah, that's how you can get a hold of me.
Yeah, and people should go look for the episode that I'm your guest on the Capital.
Yeah,
I love that. That was
that's
great.
right.
Yeah, we had a good time. Hey, Brandon, thanks for being here. I appreciate you. I'm going to move you to the back room, say goodbye. Any last thoughts or comments?
No, just Mike, I really appreciate you having me on the show. And, again, I love to stay connected. So I appreciate it. Thank you.
Absolutely. Yeah, hang on one second. Hey, everybody, that was Saturday Morning Live. Thanks for being here. Like I said, if you're new to the show, please make sure you're following us on social media, Instagram, LinkedIn, YouTube. Subscribe to the YouTube channel. We're always bringing out relevant content every day, new stuff that you're going to be able to grab hold of. If you're a new real estate investor and you're looking for a little guidance, a little bit of help, reach out to me. If I can give some guidance, some help, some direction, I'd love to do that. So feel free to email me. If you're a passive investor, you're looking for an opportunity, we are active right now in the market. We're looking for partners to partner with. If you are one of those people, again, reach out to me, and I will look forward to bringing you some information and helping you grow a little bit. So remember, we're here every Saturday morning at 10 o'clock. If you are someone who'd like to be a guest on this show, reach out. I'd love to have that conversation. You have a great week, everybody, and we will